So are we really going through what is called decoupling? This is the big discussion of the day. Just because US markets have fallen for a few days and ours have not, or rather ours have gone up more in percentage terms when the US market was bouncing back and gotten closer to the highs, and they are not closer to the highs, we are talking about decoupling. So the first thing I need to do is to get you to understand that all the highs and lows of the market, which is between the index, which is Nifty here at the bottom, and the US Tech Index on the top, that is the Nasdaq, do not occur at the same time. The broad trends, of course, remain the same, which means if broadly the US market is falling, then broadly we have been in decline or we have rallied when they have rallied. But it doesn't happen on a day-to-day basis, and all the tops and bottoms do not occur on the same day. If they really did, then it would be so easy. Now you would just look at that market and predict कि हाँ इधर ये हो रहा है, इधर ये होगा. वाह! तो everybody would just make money. सबका लाइफ आसान हो जाता. पर अगर इतना ही आसान था तो सब बैठ के बस यूएस मार्केट देख के इधर पैसा कमाते रहते. So easy, so simple. But that doesn't happen. So let us just look at just 1 year. Forget comparisons with 2007, 2004, 2002. One which I'm doing, I have also been doing, but let me set for a moment. I said forget all that. Let's look at the short term. People are cribbing about the last 200 points only, तो वही देख लेते हैं. तो जितने टॉप एंड बॉटम बने अक्टूबर 2021 के बाद, did all the tops and bottoms in India and US occur at the same time? This is the top on 19th of October 2021 in Nifty. What was the US market doing over there? It went on. So when did it really top? It topped over here. Where were we at that point of time? Down here. Already we had come down quite a bit. So there was no conclusion. So why were we not saying India market is decoupling on the downside from US? See, people just like to talk. This is all news. Makes no sense. This was a decline. This eventually declined. This was a rise. This eventually rose a bit. But look at the divergence. Now, this top occurs over here. Did we top out over here? No. This went on here, then here. By that time, we reached here. And then when this fell, we also fell. When this fell, we also fell. When this rose, we also rose. But when you look minutely, did this top occur exactly at this point? No, it occurred days before. So sometimes Indian market tops out before US, sometimes US market tops out before Indian. And usually in the topping and bottoming process, there is a 3-4 day divergence. This occurs 3 days after this. This occurs 7 days after this. And so on and so forth. So expecting कि उसी दिन होगा, उधर हो गया, अपने यहाँ होएगा, कल वो after bouncing back the US market for 4 days, it fell by 4%. So our market is supposed to fall on that day only. But if the US market keeps falling for the next 10 days, don't expect that our market will keep rising. So that is the difference. That is why you need to do trend analysis and not day to day. And I'm not a day trader. I usually look for swings that will last for a couple of weeks, and that is where the big money is. Day-to-day moves, we can keep trying to fine-tune, get right and wrong, and which is why a multi-factor approach has been taken, where we look at not just the technicals, the macro, and the Elliott wave analysis. All of them combined, whatever gives us a better idea, better picture of what the market might do, we try to take. But the idea is to understand the big picture, and therefore then we can fine-tune our short-term picture with it. Of course, there will be divergences in the short term. Sometimes we will get it wrong, but eventually we should get it right. So the same thing has happened here repeatedly as has happened at every other low and high. See, even this bottom here, at least it was 1 day apart. So it was close enough. But it's not always the case. Like here you made a slightly lower low, here you did not. Here you made a double bottom, here you made a lower low. These kind of divergences are part and parcel of the market. And so when the US market topped over here, where were we? We were still going up. We topped out 2 days later over here, and then we fell. Okay. Now just because after this US bounced, after falling some more, we bounced immediately. Then when it fell lower, we remained flat, and now we are here. It is looking like, this is looking like this. The question is, isn't that also what happened back there in January last year? Okay. In January last year, it was the same thing from here to here. Market kept going up from here to here. So here also, if it has gone up for a while, does it mean it will keep going up? Or will this keep falling and we will eventually join them down? Or has US bottomed out and going to go up, and therefore we are going to keep going up? But to think we have decoupled, the world will go one way, we will go the other way, this doesn't usually happen. these things happen for short periods and only at turning points. That is what whole intermarket analysis is, even in the big picture. So if I go all the way back to 2001, now I'm actually going back in time, which I said I won't. But to show you big picture divergences, this is the end of the tech bubble was going on. US Nasdaq is crashing. Here 9/11 happened. It crashed again. We also crashed 9/11. Yeah, correct. This is 9/11. We also crashed. Very nice. But after that it rallied. We rallied. So sort of the near-term trends are in the same direction. But when US made a new low, we also fell, but we didn't make a new low. We made a higher bottom than the one we made in after 9/11. And then we made another double bottom over here when the US was slightly higher. And then both took off into a bull market. But we went up much more because that was a period dollar was falling and emerging markets were outperforming. That's about it. But directionally, we have remained the same. But when you stop making new lows and highs at the same time, where US is falling but makes a new low, India is falling but doesn't make a new low compared to previous low, this is where a major intermarket divergence over several months occurs and signals that we may be making a bottom which has much more longer term implications. So we don't always top out or bottom out on the same day. That expectation should end. Like look at this, India topped over here. In other words, the Y2K bubble ended in India by mid of Feb, but that's also because there were fewer tech stocks in the Indian indices. So our key stocks rolled over around after the budget, which has usually been our historical cycle. But the Nasdaq continued to rise all the way till the first week of March. Now, if you see tech stocks and some of the mid-cap, small-cap speculative stocks, they also continued to rise till the first week of March. US index peaked only in later part of March, but our secondary market peaked in the first week of March. Okay, so this sort of happened and then eventually it rolled over and then everything went up and down together as it always does. So that's what I'm trying to highlight. These markets have never decoupled. There are short periods. The biggest one I remember is year 2001. So I always give this example where, the US Nasdaq kept falling. Okay, but interim during this fall, somewhere between October and February, we actually started a recovery. We did sell off a few times, but still made higher highs. And here it would start looking like India has. It's the same old story. It is not the first time in my life. This is the first time we started talking of decouple. It's also the first time FIs had started to invest in India in large numbers. Okay, before this, they used to buy only 100 crores a month. Here they had started buying 2,000 crores a month. And so that was the biggest. Now they buy 2,000 crores a day or sell 2,000 crores a day. But in 2001, a month also was a big number. But we spoke of decoupling. Did it work? No, it didn't work. Now, many years later, we are talking and I've shown you in the short term, there are many divergences. The real answer is if you are capable of judging what is the trend overall for these markets, US or Indian, and which one is going to dominate, and then you get your real answer. And for that, you need to do a much more analysis of what is happening in both these markets across analytical frameworks. And so, in that sense, I still have not changed my view yet that this is a bear market rally. We'll see how it goes. Of course, every day it pushes us on the edge of deciding that, and I've had a lot of panic calls yesterday of people, finally having lost it out on this short squeeze. If I can still call it that, because yes, the FI data was showing FIs are short, so maybe there was a short squeeze at work. The question is it done? And then are we going to roll over? And we are like 1 week ahead of a Fed meeting, which also now everybody is predicting, yes, 100 basis points karega, 75 to 100 ke beech mein kar hi dega. So maybe they'll do more. And then that will get priced in, and so it will get discounted. But will it get priced in at current levels, or will it get priced in with a further correction over the next 1 week? I think that's, going to determine everything in terms of near-term market behavior. And if it has to get priced in, then it can cause a further reaction in markets. So that's something we are going to watch for. But I wanted to highlight this divergence because too much of talk of decoupling and expectation of Indian market to, match the US market on a day-to-day basis, which is clearly not going to happen. Now the next chart I'm taking on, and this is a chart I have probably done before. So you have arrows here, and this one is to show what has been happening, say, between the metals market and the metal stocks. And again, the reason is to look for something very similar, what we call as intermarket divergences. Are they telling us something or not? Because we've recently seen the metal index hold out, and some metal stocks doing better than others. So when we look at the Nifty metal index, you might actually feel that it is making higher highs, and look at this. You had Vedanta jump up because of some particular news. But I'm only taking a single stock. I've taken Hindalco and I've taken copper. Last time people criticized me saying, oh, Hindalco doesn't produce that much copper anymore. Fine. But this is just to get an idea, okay, because it's one of the components. I could very well take a chart of aluminium, or I could take a chart of, any other commodity. But because I have clean data on copper, so I'm using that. The point to show is that many times at important turning points, you end up getting a divergence, which means here you can see a new high in Hindalco stock not being confirmed by a new high in copper prices. Okay, so commodity prices, which is what we are really trying to, and specifically base metal prices. So if you had a base metal index, I would take that. But this is what I have. We have this again here. You had this small little bounce in commodity prices and copper prices, but you didn't see a significant bounce in the underlying. So each of these divergences again occur as turning points, or they are signs of a head fake or kind of a false move. Now when you had copper prices fall a lot, I remember that Hindalco bottomed here, and we were expecting Nifty also bottomed, 15,200. We were expecting the markets to rally. For a while there was fear that still prices are falling, prices will fall, and here you had commodity prices still falling, and then they finally bottomed out. But what it ended up resulting is a divergence. New lows in prices of copper not being confirmed by new lows in the underlying metal stock. And then that got followed by both turning the other way. So these divergences have to be watched. So when you're looking at the Nifty Metal Index, using new highs in Nifty Metal Index, whether it's because of Vedanta, whether it's because of Jindal Steel, whatever may be the cause, we are not seeing it here. But even if if I take the metal index here, point is the new highs in the metal index are not being confirmed by a new high in copper prices. Okay, and so you have a non-confirmation. And when you have a non-confirmation, you must have your doubts open about what is going on, or you need to wait for additional confirmation before you really jump the gun in terms of a larger trend. It could be near the end of a trend. That is why you're getting these divergences, is you're nearer to the end of a particular trend rather than at the start. So this is how we sort of decompose the idea that you're breaking out, or it's making new highs. Is it a new trend? Are things going to get better? And sometimes a non-confirmation between one index and the other, which are related to each other, can actually tell you that we are at the fag end of something, or actually something has changed. So when we are doing intermarket analysis, what we really need to decide first is, are we comparing tops or bottoms? Because if we are comparing tops, we are looking for bearish divergences. If we are comparing bottoms, we are looking for bullish divergences. This is important because otherwise people can argue both ways on the same chart. So for example, when the Nifty is making a higher high here to here, the auto index was not confirming. And this is very similar to, say, comparing the industrials and, the transports, say in the US, if you go back to classic Dow theory. So we're trying to do the same thing. And so again, here you had a new high again in Nifty, not confirmed by the automobiles index. And so these non-confirmations showing that, not every sector is participating in this market, and therefore it may not be a strong move as far as the Nifty is concerned. And eventually both have rolled over. Right? This is one way of seeing it. So if we are seeing the same thing at the lows, we could have come up with a similar conclusion at certain point of time in terms of getting a market reversal. Now here mostly everything is rallied, but at some point of time you will start seeing divergences, sometimes in the short term, sometimes in the medium term. So even short term divergences can give you signals of coming market turns, like the new high here in the auto index not confirmed by the Nifty, eventually leading to a reversal. Now note here I am comparing bottoms. Now I can tops. Now I can start comparing bottoms as well. A new low in the Nifty not confirmed by the auto index. What is this signal? Now this signal is a sign of strength. The auto index was showing that the market is strong. We don't want to break down. And moment you had a reversal, the auto index ended up being the best performing index. So this failure of the auto index to really confirm the new lows in Nifty was also a bullish sign for the market to actually turn from the June lows. So this is a completely opposite way of looking at it. Now right now, we don't have such a signal, because at least in the short term, I think the divergence which was there between Nifty and the auto index has gone, because in the last 2 days, the Nifty has made a higher high and the auto index here also has made some marginally higher high. So we really don't have any kind of short term divergence here to talk about. But if it did, we could have taken some conclusion from there. But this is how we look at it. We search, for different types of divergences that can sometimes help us know what the market is intending to do.